I think from the point of view of trade mindset and risk management are my two big passions. You can get as technical as you want and have as many indicators as you want and everything else, but if you're risking too much of your account or not having a very systematic approach to how you manage the money that you put out there on your trades, it is a little bit irrelevant, really. So the more people can, I think, hear different angles on risk management and find a process that works for them, the better. So hopefully they will enjoy today. I'm going to do some basics, but I'm also going to go into a little bit more detail, and I've actually got a couple of trades running live that will show. So actually, we'll show the account, we'll show the money, we'll show how the plan is to add into that trade. So hopefully it will be interesting.
Wonderful. Well, let's just get started. I'm going to offer you the presenter role now, if you accept that.
Wonderful, got that.
Your screen.
Just
those of you who weren't with us last month, Alistair Crooks, you are the founder and director of the Traders Support Club, which, if I'm right, was something of a hobby that turned into a sort of a business. You're a trader first and foremost, and
that's correct.
Created this group around you, which is growing and growing. And as the name suggests, it's a network of real traders. There you are, there, and you're helping each other to make the most of the markets.
Correct. Yep. So I'll talk to the guys a little bit at the end about what we do, but if you're all happy, I'm ready to go, and I want to just get into talking about risk management, if that's okay.
Yeah, I'll hand over to you. Thank you very much indeed.
Thank you, Simon. Thank you. Good afternoon, everyone. I am going to try and make today a little bit interactive. So although I may not be able to see every single one of your answers because there's quite a few of you here, I am actually going to ask for a little bit of feedback on a couple of things, because I'm keen to know where people are at. And obviously I don't know where every single one of you guys is in terms of your risk profile, your experience, but I'm hoping that what I cover today is going to help. So the first thing for me that the first question that really needs answering is, why is risk management so important? And I think one of the things that is important to start with is the fact that it gives you longevity. So one of the issues that I see on a regular basis is people jump from strategy to strategy. They try one thing, they try another thing, they happen to be on a losing run and they see a friend or hear a webinar where somebody's doing really well. And what they'll do is they'll jump between strategies, jump between processes, rather than evaluate what they're doing. And in some cases, not all, but in some cases, what's happening is they're simply not managing their risk to a level where they are going to get the best out of their trades. Everybody's wanting the next strategy, the next process, the next best thing. When in fact, a lot of the time, people are actually onto maybe a better thing than they realize, and as a result of that, it's important that they look at the risk management element before they actually evaluate anything else. And whether I'm trading live at an event, as you can see there in my trading room, one of the things that I can't hide away from is, if I'm trading live in front of all my students, is risk management is something that they will see me do. Now, essentially, risk management is quite simple. I mean, if you look at these examples, just a couple of our live trade Tuesdays, depending on whether or not it is a day trade or a swing trade, you can see the risk management is fairly simple. But risk management usually is simple and easy for the trader when everything's going well. They're having a winning day, a winning week, and they're having more winners than losers. The key with risk management is when you're trading and you're not having the best run. Everyone, or a lot of people out there, can project, 20 trades in a row and 19 winners, or take a period of trades where all you're doing is winning, and everything looks really simple. But I haven't been or coached a trader for more than a month or two that hasn't had, during that first 6 months, or even traders that have been trading for 2 or 3 years, and for a 6-month period, 4 or 5 years in, haven't had some sort of drawdown. So I think it's really, really important to understand that that's when risk management becomes more important. It's easy to stick to the rules and stick to your risk management plan when everything's going well. The big question is, can you do it when everything isn't going as well? So, if you hit 2 or 3 losing trades in a day, have you risked too much of your account? Have you doubled up to try and make the money back? All these things happen. And I think one of the reasons why, it was something I talked about last time when I was on, is this this study, I keep going back and harping on about this study that happened with 48 million transactions across a period of a year through FXCM accounts, and it was all currency trades. And what was fascinating, and I'll touch back on it again, is that of those accounts, nearly everybody was winning. So nearly everybody going through that process was actually winning from a win-loss perspective, but nearly 90% of those people, and 48 million transactions is a lot. 48 million trades is a lot of, a fairly good spread of what's going on. 90% of them were losing more than they were winning. So in terms of number of trades, they were winning more than they're losing, but the size of the trades, they were losing more than they're winning. So you might be winning 55, 60, 65% of the time, but in some cases, on some of the currency pairs, it was actually not a 2-to-1 risk to reward the way it should be in your favor. It was actually an inverse risk reward as the average across those transactions. So what that's telling me, and it's something that I see when I'm coaching somebody new, is their focus is in the wrong place. So as I've said, when I'm in my live trading room, I can't hide. And one of the things that I want you all that are listening is think to yourself how much time and how much of your focus when you're at the end of the week, end of the month, end of the day when you're looking at your trades, how much of that time do you check in to make sure that you're running not only a risk management strategy that works over time, but you are also sticking to that risk management strategy. So I think that's the key thing to understand. So the first way to really categorize risk management. So for some of you, you might understand this. This might be something completely new to some of the other ones that are listening. I don't know. But the first thing to understand is that there are two concepts to get your head around. The first one is having a process, or the word we like to use is a methodology. So you might have your criteria when you're placing a trade. So for example, you're sitting there and you're going, right, I have two strategies that I run. So I run a pullback strategy where price has to do a certain number of things, and if those criteria are met, then I take the trade, and that's all great. And you follow that, so when you see your setup, you take your trade, whatever that strategy is. It can be a simple strategy, it can be a more complex. But what a lot of traders don't do is they don't have a process or a methodology about how they're going to manage the risk on that trade. They haven't actually thought that through. So they hit a 2 or 3 or 4 trade losing run, which is inevitable over a 2 or 3 year trading career. I don't know any trader that hasn't had that. And that's when their risk management, as I've already said, starts to wane. So the important thing to remember when you're doing this is you've got to have a risk management plan, a risk management methodology as you're focusing on the technicals. But also, I always say to people, you've got to have a risk, let me just get this up so you can see it, a risk management mindset. So please write this down. It's how you think. Risk management is not just what you do, it's how you think. Because anyone can have an elaborate plan where they trail their stops, or they have a logical place where they put their stops above or below highs, or they could have tested it over 2 years worth of data, and they've engineered their stop process to the nth degree. But it's very easy to do that differently. It's very easy to cut corners on that if you're not thinking correctly. So risk management is not just a process or a methodology, it's actually a way that you think. I remember being at a conference, and Steve Neeson, the gentleman who brought candlesticks over from Japan and wrote all the books on candlesticks, he was there, and I was speaking at a conference in Vegas and he was there, and I asked him about candlestick patterns and how many candlestick patterns he used and which were his favorites, and of all the millions that he's got in his book, he actually only uses about 4. But one of the things that he said to his audience, he said risk management is actually very, very simple. The key is being able to stick to it. So we'll talk a little bit about how you stick to risk management as we go through this, but they're the two concepts that I want you to think about as an overarching concept. And please write this down. Even the most effective risk management strategy, and I've kind of touched on this already, will have a period where it feels like the worst. And I think this is one of the most important things that anybody can think about or focus on, is even the most effective risk management strategy will have a period where it feels like the worst. I had a period last year around October where it felt like I couldn't catch a cold. I was moving stops and getting stopped out, and then the trade was dipping down and heading on and hitting target. And then the next day I was having full stake losers. So I was having 5 or 6 losers over 2 days instead of what I would normally have, which is maybe 2 or 3. And then that losing run continued. So it would have been very easy for me in that moment, over that month, to say, right, especially as other traders were making money, would be, right, I'm going to change my risk management plan. It's not working. Oh, I shouldn't be moving my stops. But actually what I have to do is look at it in the context of what I'm doing for the long term, not the short term. So whatever elaborate risk management strategy you choose, however disciplined you are, there will be times where it feels like you're doing the wrong thing. You're moving a stop and getting nipped out. You're going for a higher target and it's reaching your previous target and then turning against you. And this is why the things I go through today are so important, because no matter how effective it is for a period of time, it will have times where it doesn't work as well. So here's that famous, or this is the study that I keep going on about, where you can see here, those of you that were here last time would have seen me do this. Look, the majority of traders are having winning trades. All right, it's not 75%, it's not 90%, but across the board, and this is experienced traders, new traders, the whole lot, you can see across here that traders are having winners. You can see it there. Look, they are winning. They're winning more than 50% of the time. But look, if we look at the average gain versus the average loss, on some of these currencies, look, the average loss on trades is twice as much. Can you see this there? I think, to me, this is so big, because really, if you want to be in the 10% that are making money, you've just got to focus on the things that are going to make the difference. And very often it's not the strategy, because what they're doing, look, losing twice as much on that particular currency. Not every single trader, but a large group of them. And across the board, all currencies, the size of the loss, the average loss, is greater than the average gain. So this is something that's very, very important. So how do you move on from that? Yes, you know that it's not necessarily always going to feel like you're winning or it's going well. How do you move on from that? How do you create a process that means that you are, as I like to call it, rock solid, both in the process but in the mindset? So absolute #1 criteria is the amount that you risk per trade. So this is separate to any form of trade money or money management, which we're going to talk about in a second, but it's the amount you risk per trade. Now, I've worked with traders with lots of experience that come to me because they just can't quite get that edge. I've worked with traders that are completely brand new, and it doesn't really matter what the history is, but what I find is that all traders at some point risk more than the intended amount. Now, there might be some of you listening here that have had a couple of losers on the trot, and then trade number 3, you've doubled up. That's the famous term. So you've had a couple of losers, the third trade comes along, you're absolutely certain that the third trade is going to be the one. It's got more technical criteria behind it, and as a result of that, you then say, right, I'll this time, just this once, the most dangerous phrase in trading, which is just this once, I'm going to double up. So I'm going to risk 4% on this trade. And if this trade wins, I'll not only make all the losses back, I'll be in. And you start hallucinating, as I say to some of my clients. You start convincing yourself that this trade, you start only looking at the evidence to back up your trade. You're not looking at the evidence that is screaming at you that this maybe isn't a trade you should take. Or you forego 2 of the elements of your strategy and get in early, as opposed to waiting for all the criteria to be met. Because what you're being consumed by is the want and need to get back on the winning side, on the profitable side. But rather than wait for the trade that you can run and run it at the right risk, you're doubling up. So the amount you risk per trade is by far the most important thing. I've had traders that have come to me that have been trading for 2, 3, or 4 years and have had 8 to 9% at risk on a trade. So we'll talk about levels and what I use and everything else very shortly, but you've got to get that right. And then you've got what we call trade risk management. Now, trade risk management, if you wanted to summarize this is really manipulation of stops and manipulation of targets. So it's actually actively on the chart moving stops and targets to improve potentially the win-loss ratio, the risk-to-reward ratio, or a combination of the two. And this tends to be what I do. Now, one of the guys in my photo, one of the mentors that works with me, Martin, he tends to focus on what we call money or asset risk management. So what he will do is, rather than manipulate the stops and targets to decrease risk or increase reward, he will do more with the money. So what he will be doing is focusing slightly differently. He will be looking at increasing risk when he's on a winning run, decreasing risk when he's on a losing run. Now, that's something I don't do, but it is something that some of our students do. Some of our students actually combine the two, so they use a combination of trade management and money management. What we're going to focus on today, and what I'm going to talk about is a little bit more, is about risk management or trade risk management, because that's where my focus is, and some key things that you need to do. So, percent risk, basic assumptions. Rule number one that we have is never risk more than 2% on a trade. Now that doesn't mean you should go and risk 2% on a trade. So does everyone understand? I just need a quick yes. I think, Simon, if you're there, you can just keep an eye and see what people are saying. Does everyone understand what we mean by risking no more than 2% of your capital on any one trade? So you may have more than 2% at risk, but in terms of any one trade, no more than 2. In terms of what I do, I look at my swing trading and I'll risk no more than 1% per trade. And with my day trading, I'll risk no more than 0.5% of my trade. So for me, I can be the dumbest trader on earth in terms of technical skill, and I shouldn't wipe my account out. In fact, if I'm risking 0.5% a trade, I've got a huge amount of room to have drawdown and still be effective. Now, obviously, I've still got to have the right strategy and the right process to mean that I'm profitable, but these levels. Now, I want to ask you guys a question, if this is possible, and if I can get some feedback, that would be great, is when I say 1% maximum on a swing trade, and I say day trading 0.5% is what I do, what is your initial or immediate feeling or immediate reaction when I say that? I'm going to give you a couple of options. So, firstly, does that seem like too little? Does that seem like too much? Do you think that means you can miss out on profit, or do you think that's being smart and, you know, really kind of focusing on risk? And try and be honest. I ask this a lot when I'm working with students on an early basis when they're you know, starting out. Is when I say that, you know, I'm not going to risk any more than, you know, 0.5% on any of my day trades. How does that initially make you feel? Does that make you feel, from the point of view, oh, flipping heck, I could be missing out on profit here. Why don't I risk it just a little bit more? Or do you think that sounds sound? How does that come across to you? And if I don't see any answers, don't worry, just have a think about it. Because quite often, the initial reaction that you get actually will tell you a lot about how you may end up trading and whether or not you're going to be focusing on fear, focusing on greed, and how that's all going to play out. So when I first said this to Martin, who's now one of our mentors, he was like 0.5%. But if I risked 1 or I risked 2%, I'm going to make more money. And interestingly enough, you could see very obviously from that he was, you know, he was being driven by greed. And then that started to play out because he would overtrade. So it's often quite good to think about, when you think about managing your risk to that lower level, how does that make you feel? So for me, the reason I like managing my risk at such a low level is because what I'm doing is meaning that I can have a good day, great, I can have a bad day, no problem. And what's really interesting is myself and a couple of other education companies have been talking about 1% risk, 0.5% risk for the last 6-7 years, but interesting enough now it's becoming the norm, and I think that's fascinating because certain companies that weren't even mentioning risk and were talking about margin are now saying no, don't risk any more than 1% because it's deemed to be sensible, but it wasn't talked about 6, 7, even 8 years ago. It really wasn't something that was focused on. All people talked about was making sure you didn't hit margin. Whereas I don't teach margin. I've never taught margin in my life because I don't need to. Because if I'm risking 0.5% of my trade, I'm not going to get a margin call. I'm going to get stopped out before I get anywhere near a margin call.
Okay, well, it seems to be most people are saying it seems like a smart level. Sounds good to me. Saves me money. Says Sanj. Yes, says Marguerite. Seems reasonable for 5 to 1%, says Catherine. 1% of the maximum of cash balance in the account intuitively appears to be a hard slog to make money, says Richard.
Yes.
Okay.
Depends how you're trading. It depends what your goal is. So if you had, I mean, when I started out, if I was you in Richard's position, I would think exactly the same thing. But if you have a month, so for instance, we've got a guy, Peter, from South Africa, and he's just done 25% in 1 month, risking 1%. Now this month, what's interesting as, immediately when he started out, he had a 9% drawdown, so 9% of that 25% went straight back, but then he's gone through the month, and he's up 14%. So he's back in by 5%. So he's up 30% in less than 2 months, but he's only risking 1%. But you're gonna need a fairly high level of trade frequency. And I think it also depends on your goal. If you've got £1,000 and you want to turn it into £2,000 in 3 months, risking 1% is going to make it very difficult. But if you've got £10,000 and you want to turn it into 20 over a year, you'll be surprised how, if you use compound interest and you're focused on risk to reward, and that's the key. And I'll see this as you go through. You'll see some of my trades. If you're focused on win-loss, then it will feel like an upward slog. But if you're focused on risk to reward and you're very disciplined about which trades you take, then what you'll see is you'll start to see that actually you have 2 or 3 3-to-1 winning trades, and suddenly that starts to accumulate. And then if you compound your money, it can grow. But yes, I would be in exactly the same point as Richard if I was there. I'd be like, right, it doesn't seem like I'm going to grow my account. But again, I want to be there in 6 months to a year. I don't want to have blown my account. And remember, 5%, you don't have to have a huge amount of losing trades in a row, and you're really eating into your account. And always remember that if you have 100%, so take your account and say, right, my account is 10,000, my account is 1,000, whatever it is, there's 100% of my money. This is a really, really interesting question. If I lose 50% of my account. Now, that is 5 trades at 10% risk. That is 10 trades at 5% risk. If I lose 50% of my account, what percentage return have I got to get just to get back to where I started? So that's a good question to ask people. So simple maths, if I've got 100% in my account, 100% is X, I lose 50% of that account value, so 10,000 down at 5 or 1,000 down at 500. What return on investment do I need once I've lost that money, lost half my money, just to get me back to where I started? It's fairly simple, but it's something a lot of people don't think about when they start trading.
Yeah, 100% to get back 50%.
Yeah.
Well done, great.
So, and how many of you would be happy with 100% return in 6 months or 100% return in a year? So I would rather be safe and have the opportunity to make that than lose 50%, lose 60%, and then have to deliver on that after losing that big chunk of my money just to get me back to where I started. So I'm more about being in the game to make the money rather than the immediate thing to make the money. It's not necessarily sexy or sell seats on courses, but it works, and that's the key. So let's talk a little bit more about this, but then let me show you some trades, because then you'll see how it can accumulate and how it can move forward a lot more quickly. So we'll just get rid of all this there. So this is it. This is it in a nutshell in terms of when you're trade executing. Rule number 2, bank more than you risk when you have a winning trade. So that should be your name of the game. Rather than focusing on the winning itself, as you can see, do the opposite of what the majority of people were doing on those 48, 42 million transactions that we saw. Is very simply aim to bank more on a winning trade. Now the difficult thing here is people will do this and they'll maybe try and bank too much. They'll bank more, but they'll only bank a very tiny bit more. So rather than simply go, yeah, I had a trade, I risked 1%, I gained 1%. If I'm going to risk 1%, I want to be gaining 2. I want to be gaining 3. Now that all sounds all well and good in terms of a principle. You'll probably want to know how you do that. Well, I'll show you different ways in a second. But if you have that as a fundamental principle, so when I'm looking at a trade, I want to be banking more than I'm winning. So let's have a look at some examples here. Look, it's not going to happen every trade. Even as I've said, with an elaborate risk management process, you are still going to have days and weeks where you can't get runs. You can see here, look, this was a fairly good week. If you look at this here, Euro US dollar, or not weeks, a couple of days, Euro US dollar, 500 banked there, that's one trade split in half, 450 banked there. But if you look at pound yen, 200, that was actually a smaller loser than that. That's partly to do with my stop management. You look at this on S&P, I only banked 180, but on a large percentage of the trades, I'm banking way more than I'm losing. All right, so that's something that's really important. Let's just have a look at some of these, because look, good day there. That's basically a break-even trade. So what I've got there is no losses on that. But with an equivalent similar risk, you know, some of those trades I wasn't actually able to get double, but on one of them I was able to do it. So look at this one here. Similar example. Not able to. So yeah, I've had a good winning day, but I haven't really done great. But then if you look at this example, look here, S&P 500, that's one trade split into 3. You can see that there, 300, so it's 900 banked. So had I had a loser at about 300, 350 pound, I still would have been profitable. But then some of these trades I wasn't able to run because of my stop management. So it's not always going to work out exactly like that. But there, another one there, look. Wall Street, I've banked 1,000. Oil, I've lost, what's that, 400. So these are just some snapshots. And then it's all well and good when it's going well, look. But interestingly enough, sometimes when it's going well, you can snatch profit. But look here, 403, 300. So the minimum I'm trying to look at is always bank at least the same. I never want to be banking less, but sometimes with stop management, I'm going to have the odd trade that does that. But you can see it's not always the case. Now this is a really important one. So when you've got a day where you're not winning, you're not thrashing it out. Look, you can see here I've got 2 losers. See those there on the 16th. So I've grabbed a chunk there, 2 losers at 260. But that €1 trade cancels out those 2 losers. Here, this Euro Aussie trade 236. But look, Aussie CAD 246. Euro Pound wasn't able to do that. So it's not going to happen on every trade, but a large percentage of my trades are doing at least double, sometimes 3, sometimes 4 to 1 more than what I'm losing, and that's the key. Just give me a yes if that you can see it from a practical point of view. Who's getting this? It's one thing knowing it in theory, it's another thing being able to do it, and it isn't going to happen on every trade. Great stuff. It isn't going to happen on every trade. So that's great. You've shown me some examples, Ali. Brilliant. We'll look at some live ones later. But how do I do this? What things help me be able to do that? Because anyone can look at a potential trade and go, do you know what? I'm going to go for 3 to 1 on this trade. But then your brain's going to say something like, well, is 3 to 1 what I should be going for? Is there support and resistance in the way? What's the optimum for this strategy? What's the optimum for this market? There's news coming out later. What should I do? All of these things are potentially going around in your head. So the easiest and simplest way to improve and have confidence in the risk to reward that you pick is to track your trades. So number 1, track your trades. If you're not tracking your trades, if you're not taking screenshots of your trades, if you're not logging them down on a spreadsheet, if you're not testing the strategy that you choose to trade, you're not going to know the optimums on that strategy. So for example, if I've got a new student and they're looking to trade 5-minute pullbacks based on the particular strategy that we trade, yes, they can go and look at the data that we've got. They can go and look at the trades that we've been calling for the last year or 2 years. But I will still get them to go back and visually test that on the chart, because what that does is they start to visually see, look, yeah, Ali's running that for 2 to 1, 3 to 1, but I can actually physically see how you would do that. And I can see how many trades that would be. So tracking your trades is very important. Guys, let me know what theoretically, and if you don't know, it doesn't matter, but let me know theoretically, if you go for a greater risk to reward, so if we look at this, I'll just go down a couple here. So we say know your win-loss ratio. Doesn't mean you focus on it, but know it. Decide on a baseline risk to reward of no less than 1 for 1. So let's say you're trading at 1 for 1, which means you risk and your reward is exactly the same. You have got to win more than 50% of the time to make money. That's pretty obvious. But in theory, what is the likelihood when you start aiming for 2 to 1 trades, 3 to 1 trades, 4 to 1 trades in terms of your win-loss ratio? Is your win-loss ratio likely to increase or decrease, do you think? In theory. Obviously, there are periods of time and random distribution with any strategy you trade, but over time, if you keep going for a 4 to 1 trade, or keep going for a 5 to 1 because you've read somewhere that getting a good risk to reward is really important, what is likely, in theory, going to happen to your win-loss ratio? Increase or decrease? Any ideas?
Decrease and increase. Reduce closer to 50.
Yeah. Okay, good. Thanks, Alan.
One of each.
Brilliant. So in theory, the longer you try and stay in a trade, the less likelihood of it winning. Because if you're trying to win 4, 5, 6 to 1, in theory, you've got to not only, the market's not going to have the capacity to go there, you've got to have the psychological strength to stay in that trade. Okay, it all looks great after the fact. Yeah, you can stay in it, stay in it, stay in it, but you've got to be able to do that. And that, what we find is that is a skill that gets built up over time. So one of the things to bear in mind is that you've got to almost wire your brain to say, look, I need to be going for no less than 1-for-1. And you can see that the other guys that were in that study weren't doing that, but I want to be going for more than that, because the tendency is to see a good setup and trade it based on the quality of the technicals that are in front of you, as in it's got 5 levels of support and resistance, there's a fib retracement, there's RSI, just guys, all these different things, and you're very much in those scenarios tended to go, well, I want to take the trade because of the quality of the setup. And that's not something you shouldn't consider, but there are good quality trades I simply don't take because the capacity for risk to reward, both on the trade and based on that particular strategy at that particular time, is not necessarily one I'm going to take. So that's what I'm saying there, is make sure you have the capacity, or your trade has the capacity to do it. So if somebody says to me, well, I'm going to run my trades for 3-to-1, my first question to them is, have you tested whether 3-to-1 is viable? Because if market conditions over a 2-year period say that you're unlikely to average more than 2-to-1 and volatility's decreased over the last 6 months, and you can see that the average true range is decreasing, in theory you've got even less chance. So what you could be doing is thinking you're being smart, saying, right, I'm going to go for 2-to-1, 3-to-1, 4-to-1, but the capacity within that particular market doesn't work. And this is why I have different strategies where I will risk different amounts. I'll still stay within my risk parameters, but I will risk different amounts. But I will also make sure that for certain strategies, I may only go for a 2-to-1, but other strategies, I'll run the trade for a 3 or a 4-to-1, depending on what the numbers are telling me. Now, this is a really important one. How many of you here have ever had a plan on a trade and then you've been in the trade and you've changed your plan? Has anyone ever done that? Or how many of you have entered a trade and not really had a plan? You like the look of it, you enter the trade, and then you made the sort of exit bit up as you went along. Has anyone done that? I know I have. I don't anymore, but I know I used to do that. And I see this all the time. People come into the trading room and go, what do you think about this, Ali? And I'll say, well, what do you think about it? Because what I know, usually when they're asking me that question, they're actually in the trade and they probably haven't got a clear plan on what they're doing. So any of the people that have traded there, have you ever done that? Got into a trade with no plan, or changed your plan as you've kind of made it up as you went along?
Yes. Yeah, always change my plan. Yes, I had that experience. Oh yeah, guilty of that, says Catherine.
Yeah. Now what was interesting, I was listening to the last bit that that Rob was saying, and he mentioned that he would, if a certain candle pattern occurs, they will get out of the trade. That is very different than watching it and thinking, oh, I don't like this, it's going against me, I'm going to get out. You noticed he was saying ahead of time what he would do if a certain thing occurred. And that's essentially what I'm saying here from a more overarching perspective, is what I do whenever I'm going to place a trade is I will put the conditions on what has to happen before I enter, and then I already know, based on the analysis that I've done, where my next level of support and resistance is, what the risk to reward capacity is. And I'll do that before the trade ever sets up. And the reason I will is because if I look at the trade and I don't like the risk reward, I don't want to be at the point where I'm about to press buy or sell, and then I'm like, oh, I don't like the risk to reward on this one, but I'm so close to and so into it that I end up trading it anyway. I want to be 2 or 3 minutes, 2 or 3 hours, 2 or 3 days prior to that trade saying, no, I'm not taking that, because the best it's offering me is 1-for-1. Now, when I started out, I took 1-for-1s, and we're using that and saying it's the minimum. But now, unless I can really see a viable 2-to-1, which doesn't always mean I'm going to get it, remember, but unless I can see a viable 2-to-1, I'm not really interested in the trade. Or unless I can see a way of moving my stop up based on what I've tested, that's the only reason I'll take a 1-for-1, that I'm looking to move my stop. And you'll see me talk about this in a little bit. So 2 things just to bear in mind. Too many traders enter trades just on the technical prowess of the trade. So what I mean by that is they're looking at, I've already sort of touched on this. A lot of traders will look at it and go, flipping heck, that trade looks great. It's got everything lining up. There's additional support and resistance. The news looks like it's going to be in my favor. The trade looks so good. So they're entering it on the technicals, but not looking at it from the point of view of whether there's a decent risk to reward on offer. The next thing is too many traders risk more, which I've touched on already, risk more of their account based on the technical prowess. So they'll go and risk 2% on this trade when they normally only risk 1%. Now, I'll have minimums that I can risk, and if the trade has something that I don't like, I may reduce my risk on the trade. So I have what I call a bit of room for play. So if I have a strategy with 8 criteria and 7 are met, then I will go in with slightly less. I might risk half a percent. So I might risk 0.25 on the trade and then build the position rather than go all in at that point. And you'll see an example of this in a second. So, but too many people really, really like look at the trade from a technical point of view, so they risk more. And that's, again, a fatal thing, because remember, just because one trade looks great technically in that moment, it might be the strategy over 2, 3, or 4 years that's giving you the result. It's the 100 trades that gives you the 65% win-loss ratio, not each individual trade. So by doubling up on your risk because you think this trade technically has got more chance of being a winner, quite often they're the trades that actually end up losing. So bear that in mind. I don't double up or risk more because I think, well, I really like the look of this trade. What I might do is risk down or add in, and you'll see this in a second. So where were we? Stay you in the right place. That's it. Last couple of things here. You've got to stick to it. The reason you've got to stick to it is you want the clarity. How many of you have had a trade where you've had a predetermined target, you've got out of that trade at the predetermined target, it shoots straight past it and carries on up? Who's had that happen? Or a short trade, reaches your area of support, your predetermined target, you've stuck to all your rules, and it shoots below it. I've had it very recently with Aussie US dollar, and I'll show you this in a minute. You've got to stick to it. You've got to stick to it. And that's where tracking your trades comes in, where number one comes in. Because if you are continually taking 2 to 1, 2 to 1, but in the moment of the trade you're like, oh, I could have taken 3, could have taken 4, trades run on, sooner or later you're going to start to, or the potential is for you to start and try and get more and more on the trades. But actually what you want to do is document that. So go back and actually log down. A lot of people log down whether the trade was a winner or a loser, but what they don't do is go and log the trade and see 3, 4, 5 days later, or whatever it is, 3 or 4 hours, whatever time period they're focused on, where that market went and what percentage of their trades are doing far more. Because if that's the case, then they could potentially start looking to increase the risk to reward. But a lot of people will just log down, yeah, it was a winner, great, yeah, it was a loser, great, or not even that, they'll rub it under the carpet, they'll just brush it under the carpet. So it's really important to think about sticking to it, and if your trade shoots on by, leaves, you feel like you're leaving profit on the table, start logging it. Or you may see that a couple of times, go back over your trades. So sit back and go back over 3, 4 months worth of trades. I'm working with 2 people at the moment, Alina and Narain. Okay, and they're now following what Peter's doing, and what they're doing is they're going back and testing all of the trades that they place. So let's say they're trading 4 markets, pound, euro, Aussie, and yen. They're day trading those. What they'll do at the end of the week is they'll go back and back test the entire week to see how many trades they missed, but primarily to see whether or not there's ways that they could improve their risk management, which is in line with what you were saying, Richard. So they may only be risking 0.5% or 1%, and at the moment banking 2, 3% a month. But what they're noticing over time, not just one trade or 1 week, they're noticing over time that on a lot of the trades are running further. So it's now that they're bringing in a trade management plan that allows them to look to get the 3, 4, 5, 6, or 20 to 1s in some cases. They're not going to come along all the time, but if you can manage your trades correctly, you can pick those up, and that's where you can start to see things move up more quickly. Now, last one, don't get cute. I see this all the time. Don't get cute until you have the data and experience to do so. So one of my bugbears is I'll pick up a trading book. I don't tend to read a lot of trading books anymore. But I'll pick up a book and it will say something like, you know, get your stop to break even, because then it's a no-lose trade, or, you know, cute phrases like never have a limit order, always get stopped out of your trade but get stopped out in profit. And I find these types of things quite frustrating because there's never any context behind what that person is saying, or if there is context, often the context relates to how they trade or the theory that they're putting down in the book, and actually the reality of delivering on that is very, very different. So what we say, and please make a note of this, is start very simply with what we call all-in, all-out trades. So if you're new to trading, start all-in, all-out, which means entry, stop, target, entry, stop, target, or entry, stop, limit. Aim for that to be above, as far above as what you've tested, above 1 for 1. So if you can go for 2 to 1, do. bear in mind the relationship between going for a higher risk to reward and your win-loss ratio. Very simply, you could be looking at the more that you want to try and go for the 2s or 3s to 1, the more losers you may well have. So log that, but start in that place. Just go all in, all out. Then you can start to look at what I'm going to talk about now, which is advanced concepts. I'm going to quickly go and touch because I can see time's ticking on already, so I want to show a couple of the trades that I've got in here. So the advanced concepts would be something like this. It's trailing stop. Some of you may have heard about that. So that means moving your stop up or moving your stop down to either minimize the risk or lower the risk, or move it into a profit-based period where you're actually into pure profit. Increasing limits, so that's something not when you're in the trade, but like I've said, you test over a period and you start to push your limit out. Beware that psychologically that can be tough, especially if you've been taking fairly standard trades on pullbacks, previous highs, previous lows, where if you've been used to taking profit at that level and suddenly you're aiming for an extra 50% on that trade, psychologically initially you may find that a little bit tricky. You have to build up to it. Another way is adding in, or what we call building a position. So adding in or legging in, and another one is legging out, where you take money off the table at certain points. What I like to do is I like to trail my stops and bank some money if the trade moves in the direction I want. So what I'm able to do is essentially get to a break-even perspective, but I'm not purely break-even based on moving the stop. I'm break-even based on taking a little bit of profit, leaving a large chunk of the trade in, and then moving my stop up a certain way. And I'm going to show you a little bit of this right now. So might as well look at a trade from last week. Now, what I want to do is just give you guys a little bit of a test. So I'm going to show you last week's trades. Now, last week wasn't great for me. Okay, so last week wasn't great at all. But this is last week. So look down here. So if we look at it from a win-loss perspective, okay, so if we look at it from a win-loss perspective, and I look at it, that's, by the way, that's one trade, and then we're going to go and look at that trade in a second. So that's one trade there. One trade, that's one trade. So that's just one trade split in terms of where I've entered the trade and where I've got out. So what are we looking at? 1, 2, 3, 4. A 12-point win is not a win. That's just hovering around a break even. So 1, 2, 3, 4, 5 wins. 1, 2, 3, 4 losers. So if you think about it, my win-loss ratio very good last week? No. So I'm looking at 5 winners, 4 losers, couple of break-even trades for sake of argument, those two there. So that's break-even. That one slightly profitable, but essentially break-even. All right, it's got a little bit, I got positive slippage in my direction on the broker on that one. So, however, based on that, if you look at the numbers, was it a profitable week? Yes or no? Absolutely. Not a great profitable week, but if I can walk away with £600–700 for the week, something like that, maybe £500, I haven't actually got the exact numbers, but if say I can walk away with anywhere from £300–400, and I've had a fairly poor week in terms of the trades running, but if I can have a couple of trades, look there, £500 banked instead of losing 3, £600 banked instead of losing 3. That means that a poor week doesn't mean I'm down 2, 3, or 4%. And essentially that's what I teach my students to do. Now theirs might be a smaller amount because they're trading with a smaller amount. It might be a bigger amount, who knows? But all of that is done with £300 being 0.5%. So even if these were all losers, I'm still only looking at 2 or 3, 4% maximum down in a week, which makes it a lot easier to sleep at night. So I would rather be in that position and have built my account over 6 months to a year to 2 years to 3 years than be sitting there forever losing money and forever being stressed out about what I'm doing. Because then I can look at the market objectively, and it's easier to run a trade for longer if you only have a small percentage of that trade at risk. But let's go and look at this a little bit more technically so you can see, look, why in this trade have I only got part of it at 185 and banked part of it at 456? It's all about managing stops and looking at things from a slightly different perspective. So I'll just get rid of all this. Bear with me 2 seconds. Just flipping to my charts. Right, so we'll talk about Swiss franc yen in a second because that's one I'm live in, but we'll go and have a look at Aussie US dollar. So I got a lovely technical setup on the daily chart, and I'll just show you this. So I got a lovely technical setup on the daily chart, but from a daily perspective, the trade that I was looking to take, and I'm just going to highlight this so you can see it a little bit more. The trade I was looking to take was in this little zone here. So this was the zone where I was looking to take the trade, okay? And my target was the previous high, okay? Now, can everybody see that we've run on here? I'm sure you can. We've run right past previous highs, so previous yearly highs. I can't really draw very well with this pen. It's not the one I'm used to. So previous yearly highs. So for me, I didn't know this was going to happen, okay? So when I'm taking the trade, I'm looking at the previous highs just here. I'm looking at these highs just here. So I'm assessing the risk on this trade, but I'm using the technicals to determine where I'm going to exit that trade. So for me, I wasn't choosing to try and run this trade for a long period of time because I had clear technical analysis, prior highs a little bit higher, previous high from the pullback like this. But what I didn't like about this trade was that the pullback was slightly lower than the prior highs of the last higher high. In an ideal world, I want the trade to look more like this. So I want the trade to have a slightly stronger move up and then the pullback come down and look more like that. It doesn't have to be exact, but more like that. However, if we'd been too much higher, we would have come into the prior highs of the year, and then I'm less likely to want to take a pullback trade because the evidence last time we were here and the evidence the last time prior to that was that the move back down was much greater. Now that may not have been the case this time, but I can only go on what has happened. So as a technical trader, I'm only going to go on what has happened previously. However, what I can do is, although I still like this trade, what I can do is I can go to a lower time frame. And this is what I teach a lot of my guys to do. Go to a lower time frame to optimize their entry, but also go to a lower time frame to optimize your risk to reward. And I'm going to show you this now. This was the Aussie trade that you've just been looking at. So if I go down to the 4-hour chart, 4-hour chart's one of my favorite charts. I know you shouldn't really have favorites, but I do like the 4-hour chart because it's that kind of gateway between what's going on a daily and weekly and how you can relate that to a day trade. So what we've got is essentially that same pullback that started to bottom out, and then we've had a trend line break, and then we've had a break of the prior highs, as you can see here. So very simply, what I was doing with this trade was I was looking for 2 entries. So I was legging into the trade, but I was also looking to manage my stops. So keeping it very simple, this pen's a bit tricky, but I would be entering at this level here, entering at this level here. Now, on the face value of it, if I look at this trade, the risk to reward is not that great. Can everybody see that? It's not like I'm looking at this trade. Those prior highs just here, those prior highs aren't that great. It's just over a 1-for-1. Even if I was tucking my stop under there, then the risk to reward isn't too great. However, we know that there is also prior highs a little bit higher at this level here. So what I can do is I can leg into the trade, which is essentially split my entry, look to move my stop, but not move my stop up too tight and then get stopped out. So when the trade triggered, which was approximately here, the trade triggers, my initial stop really meant that I wasn't much more than 1-for-1. But as the trade starts to move and gets halfway to my target, what I do, and I've tested this, I'm not just making this up as I go along, is I would move my stop halfway up. Now the reason I only move it halfway up, I got asked this in the trading room, why are you only moving it halfway up, Ali? Well, because my testing results say that if I move it all the way up, too many of my trades come back and stop me out. This one looks great because it's run on, but too many of my trades over too long a period of time would stop me out if I was too aggressive in my stop movement. Now, had I moved my stop to break even on this trade, it would have been fine. I could have moved my stop all the way up to break even and it would have run on fine. So the individual trade doesn't really matter. It's more about what my data is showing me. But then what I've got is on a lower time frame, I've got a small move back down that you can see here, and that's an opportunity for me to add into the second trade. So the first trade was about £8 a point, stop down here, very quickly got my stop moved up. But once I can move my stop up, if that first trade was 0.5% risk, and I move my stop up halfway, then I've only got 0.25 at risk. So if I can then enter the trade again on a lower time frame, I can add into that trade, and if I only risk 0.25 on that add-in, I'm back at 0.5 risk, but I'm also running one trade in profit, one stop that's a little bit closer, and then when we break that high again, I can then move the stop of my second trade further up. So essentially what I'm doing, it's a little bit tricky to explain in 1 hour, but what I'm doing is if the price is favorable, I'm laddering. So I'm only risking 0.5% on the trade, but if price does what it wants, I can slowly move up my stop, look to potentially enter, and then if that moves up, enter again. But never, what I'm not doing is doubling up. I'm not saying, right, I'm going to have 0.5% risk on this trade, and then what I'm going to do is if it starts going in my direction, leave the risk at 0.5, and then take another trade at 0.5, because then I've got 1% at risk on a trade that I would normally only have 0.5. So the risk becomes very important to me, and if I'm going to add in, I have to have brought my risk down. Too many people add in because they feel confident the trade's going in their direction, and suddenly they look at a trade and what should have been a 1% is now a 2, or what should have been a 2 is now a 4, and then at any time if the price wants to correct itself, if they are too exposed, that could happen. So the worst case scenario is not that you could have a winning trade that you missed out on. The worst case scenario is you could be in a trade, you could have added too much to it, and it loses. Losing trades are not the worst case scenario. Losing trades that you've risked too much are the worst case scenario. So that was one. But I want to just take you, if we've got time, 4:51. God, an hour goes quick. So again, this is the sort of thing that we would be doing live in the trading room, but what I said earlier, we will be doing these live and I'll be looking to place these trades and going through what I'm going to do ahead of time. Now we've actually got a live trade at the moment. I'll just pull this one up. I don't know how it's doing. Well, yeah, it's only up a small amount. So if I just pull in my broker, you can see here, I've only got a £2 a point trade running at the moment, up 32 quid, and that's on Swiss franc yen. But I have a plan, and let me explain. It's a very similar plan, so I've entered at a very low risk, but I'm going to go through this and just show you what my intention is. And I've already got one order ready to go, and I think, in fact, we've got quite close to it. So if I just pull up Swiss franc yen just here. Yeah. So what we've got is a very similar trade that we had on Aussie US that we've got on Swiss franc yen. We've got that main pullback that I look for on the daily chart. I'll just wait for the chart to tick over. It seems to be running a little bit slow at the moment. So we've got that main pullback down into the moving average. We didn't make the prior highs, so I'm always aware of where the prior highs are for a possible pullback to that level, which is one of the reasons I'm only in this trade at £2 a point. Had this same price action occurred and it had occurred lower down, then the same entry that I would have taken would have been £4 a point, because I would have been willing to have risked 0.5% on this trade. At the moment, I'm only risking 0.25% on this initial entry. But if I just show you what's going on, you'll see this concept right there. So if I just go back to the 4-hour chart, so remember, I'm risking half stake. No, full stake for me on this trade is 0.5%. So I'm risking half stake. So my initial entry onto this trade was here. So initial entry is here. I was waiting for that pullback, but then waiting for it to bottom out, break the trend line, positive close, and then a break of that candle there. So that got me the trade. Now I've been in this trade pretty much all the week. It's done nothing. My stop's down here below the low. You can see that really earlier on today we've taken a fair bit of heat. We've come down here, but then recently we've had a move up. That might be news. I haven't really had a look. But my next order, remember what I talked about adding into the trade, my next order on this trade is a break of this level. And then if that was to happen, I would then look for a 5-minute pullback, because I know that if that happens, there's a high probability of us reaching the prior high. So what I want to do is I want to add into that trade. Now, if you were a swing trader, you wouldn't be able to do that. You might be all in it, the moving average on the daily, and literally just trading it up to here. But even if you were doing that, you'd still have a good risk to reward. Now, the initial trade that I've got here has actually got a slightly better risk to reward than Aussie US. You can see that there, about 1.5 to 1. However, if we break this high, I'm going to be going into this trade, and I've got another chunk going in. But what I can do if we do that is I can then move my stop on this initial trade halfway. And that second chunk is a higher stake, but it's a smaller size stop. So again, I go from a 0.25% risk. If I move my stop, I go down to a 0.125% risk. or whatever it is, basically half of that. So it's almost nothing at risk. And then what happens is, if that stop goes up, I can now add in here, and I go back up to 0.25. But now the trade's moving, I could probably push that to maybe 0.3, maybe 0.35. I'm not going to, but it gives me a little bit of capacity because the price action is showing me, if this high gets broken, that it wants to push up. Doesn't mean it will, but it wants to push up. So at the moment, it looks like, flipping heck, Ali, you've only got £2 a point on this trade, but I can do that, add in here about £6 a point, pullback comes, and then the overall bank, if we get up to this level, would be £600 plus. So well above my 1% risk, let alone my 0.5% risk. So from this perspective, I'm looking to risk about £175 on this trade overall, and I don't want to see that go any higher. Risking £175, I re-enter here, I'm above that, I half my stop, I'm at that level to bank about 600 if we get up to this high. And I do think there is potential to reach possibly the monthly R1 or the round number, we've got 120 a little bit higher. So basically to summarize, guys, if you're going to start doing cute things like I'm doing here, you have to have the data to do it. It's no good moving stops halfway all the way to zero if you know that, if you don't know whether or not a large percentage of your trades go into profit, pull back, and then go up, because that does happen. People think they've been smart, and then they say things like, "Ah, well, it was only it was a break-even trade. It was I didn't lose anything." But 3 or 4 of those trades where you keep getting stopped out at zero that then run on to your predetermined target, that could be the difference, that when you do hit an actual losing run where you don't get the chance to move your stop, those trades that ended up being a zero that could have been £600-700 or 1% or 0.5% or whatever it is, 2 to 1 here, that should have been a 2 to 1, 2 to 1, that break-even trade 2 to 1. You then have a run of 1% losers. That's where moving your stop up to break even, because you've read it in a book or heard it or seen somebody doing it without looking at the context, is really, really dangerous. So actually, when you think you're reducing your risk, you can actually be more risky, which is why all the traders that work with us go and test, go back and look at all of their trades, document on the spreadsheet, go and look at screenshots, go back historically on the chart and see whether or not moving their stop is actually going to work. So that is about all I've got time for, I think. So I just wanted to end by saying that last time it was great. We had some of the guys that were at the round the clock session that have come on board and taken us up. Now I've got a small offer that I think it would be useful if you guys want to find out a little bit more about what we do, find out a little bit more about what Trader Support Club is all about, get some content, actually get some trade signals and get involved with what we do. Because for me, trading is a very personal thing. We've worked with people that have been currency traders, commodities traders. We've worked with people with no experience at all. And we have a range of different products depending on what it is you want to do. But what we say to people is it's very important to know what it is you want to achieve, know a little bit more about us before you start, spending lots of money and getting involved. So what we have is we have a base level, and that is called the Foundation Plus. Now, Simon, we've actually changed it a little bit, made it a little bit more organized and easy for people. So the main website is tradersupportclub.com. Hello there. Our Facebook page is Trader Support Club, so feel free to follow us on Facebook, see some of the live trades, see what everyone's up to on there. But what we've got is a special offer just for round the clock trader students, anyone that's been here today. And basically that is access to our Foundation Plus membership level, which is usually £99 a quarter, but you can go and access that for an entire 3 months for no charge at all. Now, where you need to go to, you actually don't go to our main website, you go to our membership site. So this is where all of our members log into all of their material, and that's www.tscmember. Now the link has changed, Simon. It's now, rather than join free, we've actually set it up as RTCT. So .co.uk/RTCT, and if you head to that link, and I'll just show you what the page looks like, you can just join up. So it's the free offer, 3 months access entirely for free. So all you need to do is fill in your details. You'll need your email. Don't forget, we won't share your email with anyone. So your email, just some basic details so you can access the material. What I would ask as well is when you go through, it will ask you to tick how you heard about us. Please make sure you tick round the clock trader, because we send out little freebies, little nuggets, bits of bonus material. But sometimes if I'm producing a piece of bonus material, I might not be sending it out to every single person that's come and found us. I might want to send that specifically to you guys. And if I don't know that you're from Round the Clock Trader, I won't be able to know to say you won't necessarily receive that piece of material. So when you go through the sign-up process, please make sure you tick Round the Clock Trader. And then what will happen is you will get access to the Foundation membership area. You will actually see all of the programs that you have access to. You have access to an entire training program. You have a coaching webinar series that I've done that goes into risk management in more detail. We have a signal service that you can follow. We have a so that's the webinar series there. We have a weekly coaching webinar with one of our traders, so you can actually get involved and get some feedback on what you're doing for an hour every single week. And if there's more you want to find out about what we do, or you want some more help, you can actually have one specific call with one of the team as well. And it also shows you what other products that we have available. But we think it's really important that you get involved, try before you buy. So please make sure you go to that link. You don't need to go to our free tab. You just need to go to that specific link, and then at the end of the 3 months you will get the option if you want to continue at that level at £99 a quarter, great, or if there's other levels that you want to be involved in or find out more about, you'll be able to do that during the process as well. So I hope that's been beneficial, guys. I'm sorry I've run over by a minute. I hope that was useful. Thanks ever so much for having me back. As remember, there's the link there, so tscmember.co.uk/RTCT. Keep a track of that trade, Swiss franc yen, and I'll look forward to seeing you all again soon.
Thank you very much. Alistair Crooks from Trader Support Club, thank you. That link is actually in the chat box, so you just need to click on it straight from the chat box.
Wonderful.
Thank you for setting that up, Ali. That's great. Thank you.